Hello, and welcome to this episode of Nucleus Wealth Empower. I'm Shelley George, Chief Operating Officer. So last week, the Reserve Bank of Australia increased their official interest rate by 0.25% or 25 basis points. This represented the first time they had increased this rate since November 2010. So it's 11 and a half years. That's a lot of first home buyers' first ever experience of a rate hike. It represents a 250% increase in the official cash rate and a potentially 10% increase in the interest rates some owner-occupiers face. So despite the increase only taking the official cash rate from 0.1% to 0.35%, Talkback Radio was ablaze after the announcement, and it looked like a battle in the ongoing war between baby boomers and millennials. So I wanted to find out who really has it tougher and why. And so to help me answer these questions, I've got Nucleus Wealth's Chief Investment Officer, Damien Klassen here. Welcome back, Damien. Thanks for the visit.
Thanks, Shelley. Yeah, I'm as Gen Z, I'm so sitting in the middle, Gen X, so I get to adjudicate. Is
Excellent. Well, I hope
it's not going to be clear and clean. One party has the ear of politicians and deeper pockets, so yes.
So that doesn't bode well. Yeah. Okay, before we get into it and I forget, a quick reminder that please keep in mind that any advice in the show today is general in nature and it doesn't necessarily relate to your personal circumstances. So if you'd like to discuss anything, you can get in touch with us on 1300 623 863 or contact at nucleuswealth.com. And if you haven't already and you like what you see, subscribe and click the notification bell to be notified when Nucleus Wealth goes live or has a new webinar to watch. Or, of course, you can follow us on your preferred podcast platform and help our show grow. So, as I said before, I first came across this topic or the concept of this battle listening to radio or a breakfast show after the announcement was made. And a lot of the comments there were really sort of, I've got it tough, no, I've had it tough, or that sort of thing. So I wanted to dig in a bit deeper with you and try and get to the bottom of, does anyone have it tougher, or is it's all just, sort of relative? And obviously you've done this incredible property. So we can have a bit of it. We can use that to, I guess, look into it. But what I want to actually start with is, I want to ask you about how we got to this point of a rate rise. And I think a large part of that was a big inflation print that happened. Was it just the week before or 2 weeks before the rate rise? So how much of that is driven by demand, I guess, a hot economy? Because I think of interest rates as being increased to try and decrease what is a lot of heat in the economy and stop things getting out of control.
Yeah, absolutely. And think about inflation is sort of where it takes supply and demand to meet. And so usually when you've got an inflation problem is we've got this supply that's sort of gradually growing, making products for people and giving services and haircuts and building roads and all these things that are sort of going along as part of sort of a normal economy. And it's running hot because we're starting to run out of people, and so we need to actually get wages higher to in order to bring more people in to do these jobs. And so it's getting hard to find a builder, it's getting harder to find a hairdresser, and so these the ones that are in demand are putting their prices up, and that's what's causing the inflation. So that's sort of at a core. Usually it's because we've got too much demand. The supply is relatively fixed, and supply is usually increasing all the time, and then you get this demand starts growing too quickly, and supply can't keep up, and that's why we get it. This time is very different in that this time round, it's mostly demand is roughly where it's been before. There's been a bit of a switch between services and goods. So people, when they're all locked down, wanted to buy more goods, and weren't doing as much eating out, and weren't doing as much, getting massages and haircuts and all those types of things because they couldn't. And so so this demand, sorry, and then we've got these supply chain problems that are coming through, mainly out of China and the transport concerns, but there are other ones now starting to emerge from the Ukraine. And so what's happened this time around is we've sort of got this demand, which is about average, maybe a little bit weak even, and it's facing a very weak supply. And so the idea now is that what we need to do is, well, what central banks are saying is we need to do is we need to smash our demand down to a level where it meets the weak supply. And so, so it is a very different outlook to what we've had before, and it's quite different to what most central banks were talking about for the last 18 months as well, and in particular the Australian Central Bank.
It also results, I think, in a very different outcome, in the sense that the effect on GDP is very different, isn't it? When you have a weak to average demand, I guess, base that you
Mm.
then crunch by taking more demand out of that, as
Yeah,
opposed to when it's strong and you're out of that.
yeah, that's right. And so for Australia, it's about it's you'd ordinarily say it's a question of we put up interest rates that helps slow down the economy, largely by increasing the unemployment rate, but yeah, taking more money out of people's pockets, which then means people spend less. They'll wait a couple of days more to get a haircut, wait a couple of days more between getting massages or whatever all of the various things they're spending. This time the problem is, um, you're not really going to fix those problems overseas, and so it is a question of saying, okay, well, we need to buy fewer things from China, effectively, is what we're saying, so that inflation doesn't get out of control. But the problem we've got is that we're a small country in a big world, and so if the US keeps buying lots of stuff from China, then we're going to be importing inflation from there and having supply chain problems regardless. And
Mm.
so it's a very different beast this time around, and it is actually, for I think some of the more dispassionate observers, sort of similar to our view, is that, look, it's very hard to, this isn't the type of inflation you can control with interest rate rises. Someone like Ross Gittins, for example, wrote up a piece last week, basically explaining, very similar to our view, is that this is not the issue. But on the flip side, you've got a whole bunch of people saying inflation's running out of control. You've got to do something, and that's where I think central banks have sort of ended up going, well, we've got to do something. We only have one tool, so therefore we put interest rates up.
That's true. And I think that, recent memory for me in Australia, at least, is that the government, which obviously have control over some other tools, have not really engaged with the messages that the RBA has been sending them or pleading with
Oh
them. So,
well, yeah, we've got both sides of Parliament. Both sides have got both
both.
main contenders. First side, yeah, main contenders for the next election are both out there with big spending plans. So they're basically trying to get the economy to run hot as well. So yeah, that's one more reason to raise rates. I guess they're sort of working at cross purposes too, and I guess even more so than usual is we've actually got a lot of little presents coming our way in terms of, here's some extra money to get us through the problem. Here's some extra voting money. Basically for this election,
So
that there's.
you're getting given with one hand and taken away with the other.
Well, that's right. So, but I guess it's the difference between going, if there was, say, there was a long-lived tax cut that was
Mm.
coming through. It's like, okay, well, that will give support to the economy for a very long time, and
Mm.
because it'll keep giving support over time. Whereas now what we're getting is we're getting a one-off cost of living adjustment for a number of people. There's, in theory, I guess, a short-term cut in the fuel excise that will, I guess, in theory, come back on again. And there's the low income tax, is like, this is the last year they're getting this low income tax credit. And so it's like, over the next few months, we're saying, okay, we've got this problem with inflation. Let's throw more fuel on that inflation fire, and then we'll take it all away again. And so it's like, and then as the interest rates are rising, we're sort of, you were throwing some extra fuel onto this fire, and then we've got somebody dousing the fire, and we've gone, oh, we haven't added any more fuel that's going to burn for a long time. We've just been adding fuel that's going to burn, for the next 5 minutes. So yeah.
All right, that doesn't look like the scenario I'm excited to be going into. But as I said at the start, the idea here is to have a look versus what they were in the 80s when we had interest rates as high as 17%. So let's get into that.
Mm.
Um, where do you suggest we start when we think about this comparison?
Yeah, so let me pull up the property calculator. So the idea behind this property calculator is really to try and show off some of these exact measures. Is that what really matters? For example, is how much are people paying in it for a mortgage now versus what they can pay, what they can buy for rent, as an example, or how much are they paying in mortgage versus how much they're earning now. And that's exactly the types of things we want to try and get to. So what I'm going to do is we'll look at houses just because that's a bigger market and sort of more widespread. Uh,
So this is
it's
available on our website, right? You built this, and
Yes.
it. I think from memory, you've told me in the past the idea was to use it as a sort of a comparison for making investment decisions in housing, um, whether that's as an investment property, between housing and shares, or as a consumption decision, housing as a rental expense or I guess capital expense.
Mm. Yeah, the idea, and it's what I was really the yeah, from my analysis, what really stands out quite clearly is that interest rates are really important when it comes down to the value of property.
Okay.
And what I did is effectively make this calculator to to illustrate that to people so that people could change their assumptions themselves and see what it does to property prices. So it was this idea that if property prices are actually going to sorry, if we've got rising interest rates, it's very difficult to have rising property prices at the same time, especially if we're coming from such low levels. But
Right.
but let me yeah. So we'll start with a house in Sydney for $1 million, just to which is the median price in Sydney is about 1.5, 1.6 at the moment. So we're talking about a cheap house in Sydney. Um, Now automatically we'll throw the rent in for you, just that this is like
Okay.
the default rent for that. So it's the default rent is $578 a week or $30,000 a year. Um, you could go through and change that if you're looking at a particular property yourself, or you've got different areas. Obviously, have different yields, but let's just go with that. Um, I'm going to ignore this the growth environment for the moment. So if you're looking at it for the purposes of doing a property valuation, you'd use that. But actually, the thing I'm really trying to look at now is these extra screens we've got here. So we what we are the what we're suggesting here is there's four different ways you can use to forecast. One is the mortgage cost versus rent. Another one's a mortgage cost versus wages. Uh, there are two key ones. Then you could secondarily look at property price to wages. Now that's helpful in some ways, in that you want to know how much you need to save for a deposit, but it's not an ongoing issue for people. Once they've saved the deposit once, now you're actually really worried about for the next sort of 25 years, how much is my mortgage costing me, how much am I renting, how much is my mortgage costing me, how much is wages. And then finally there's a rental yield one, but we'll ignore that. That's sort of like more for investors. We'll ignore that one for the moment as well. So when we look at this mortgage cost to rent, that then gives us these figures down here. Oh, sorry, I picked the wrong one. Sorry, I still on property prices to wages. So I'm just going to zoom in on this chart now, so that we can see a bit more clearly what's going on. Hopefully, we can still see that. Yep. So I've just zoomed in. So this is Sydney house prices. The mortgage cost to rent for the over this the last sort of 40-50 years. And so what we can see here is that it's 100% is the line where it costs you the same to rent as what it is to have a mortgage for a 25-year mortgage, paying principal plus interest
So that's on the $1 million property.
on the $1 million property.
But they'll, because the calculators use the, so we've put in the property price, but then we've used the calculator's assumption around the rent. So I guess if you change the
Yes.
price and kept that rental assumption, you'd still get this chart. Is that right?
Uh, Well, the price changes. We're looking at the historical amount the rents were. We're looking at the historical amount for
So
prices
it's
and the historical
irrelevant
amount.
what you put in for those assumptions
Yeah,
when you're looking historically. Okay.
yeah, exactly. That's right.
Okay.
Yeah, what the numbers you just put, I put in the $1 million or whatever doesn't actually make any difference. Yeah.
Okay.
So what it's basically saying is that for me anyway is that when you can buy a Sydney house for less than what would cost you to rent, which was sort of what happened in the early 80s, and
So
what was
when that's
happening throughout
below
the
one,
90s. Yep. So when it's 100%, um, it's that seems to be a bit of a lower bound for this ratio.
okay.
So it tends to so and I guess the idea there is people look and say, oh well, it's costing me $700 a week to rent. I can buy a property, pay $700 on my mortgage, and then I can have the property and and it's mine. And then it seems though at the 200% starts to flip it the other way. So once it becomes twice as expensive to um, in that same scenario, I'm renting for $700 a week, and I start looking at a mortgage, and a mortgage is going to cost me $1,400 a week. That seems to be when people start going, oh, well, that's too much. And then somewhere in between seems to be the longer term average. So we've got those up on here. Your 1.46 is the 10-year average, so roughly halfway. So when people can pay 46% more than whatever the rent is, they seem to be that's what the average has been for the last 10 years. The 30-year average is more like 1.28. So, but having said that, that's sort of, as you can see here, is made up of some big chunks of underneath and some long sections of a lot higher than that. And so, if you're looking now at the at this from as a long-term period, well, millennials, since 2006, you've basically been at 150% or so. So you've had to pay 50% more if you wanted to buy a house than if you wanted to rent. Um, for boomers, yeah, they basically had that happen for about a 2-year period, back when interest rates did peak at out at that 17%. So um,
So
yeah,
why does the chart go up like that to 1990?
is the interest rates was
That's the
the
interest
main
rate
factor.
movement. Okay.
Yeah, that's your main factor there of interest rates rising quite dramatically. You had then price falls and interest rates falling at the same time after that, which sort of
To bring it back in line. Okay.
mm, yeah, and so and that is the you know the, that's the issue with all of these is saying you've often got two or three things moving. So well, you've effectively got three things um, in this scenario. You've got the rent, whatever the rents are doing. You've got whatever interest rates are doing, and then you've got whatever prices are doing. And that's sort of this chart's giving you a mix of all those three. Um, so yeah,
Okay.
so on that battle, the peak was certainly higher. So you peaked at 1.85, which is back to it peaked a little bit higher than that in the just before the financial crisis. We're still a fair way off that at the moment. It's still 1.6, but keep in mind, this is with no interest rate rise. Well, one interest rate rise in the bag so far,
Sure.
and it's
Okay.
been a consistent period of much higher. So
Okay.
okay.
So the jury's out on this battle. No one is excessively better or worse off, or
Oh, look, I would say that you'd say the boomers had an acute crisis for a 2-year period where they were worse off.
okay.
Uh,
Yep.
m- yeah,
The
millennials,
av-
and so pick any other time except 1998 to 1990, then though because you look at all these periods back there, you look just 2 years earlier, in 1 year earlier in 1987, and you're paying 30%
okay.
more. And right now we're paying 60% more for to buy a house first. So
Okay.
this is the based on the median Sydney house price as well. Median Sydney house price, median rent. Okay, so that's so yeah. So it depends on whether you like your problems to last for a long time and be painful for a long time, or you like them to be very painful for a very short period of time.
Well,
So
there's certainly value in stability, isn't there?
yeah, that's right. And all there's boiling of frogs, and
Yeah.
could it be a frog that boils, or a lobster that get cooked, dropped in the boiling pot. So pick your, take your pick. Um, so that's one way of looking at it. The other way, then another way is we'll look at the mortgage cost to wages. So what this is then doing is saying let's take the average wage in the state, the average full-time wage in the state, and compare that to to that same mortgage cost. And a pretty similar story. It's probably this one goes back a little bit more to boomers though. You would have been paying 70% of the average full-time um, in,
Wage.
back in the full-time wage, yeah, back in the late 1980s. So whereas at the moment you're paying about 57%. Um, and keeping in mind, I guess that 30% is the housing stress level that is suggested by most international sort of bodies. So yeah, most international bodies suggest that 30 once you get above 30% in a city, then you're talking about housing stress.
And is that what the
So
banks use as well as a level when they're approving mortgages, or it doesn't come into their consideration?
the banks do use
I
something
thought they used a
similar.
third as well.
Yeah, yeah, might be a third. And keep in mind, this is only one. This is one. I've used a salary. So if you've got two people working,
Okay.
then that
Oh,
obviously
right.
have
They'll
to as
consider them
well.
both. Okay.
And yeah, yeah, this is but um yeah, that's I guess the argument is look, I could use two people and just halve everything if I wanted to, but I'm using one because it's a bit easier to see across time. Um, yeah. So where we are now though as well is 56%, which is well above the 10-year average of 45%, and well above the 30-year average of about 40% of income.
Hmm.
So on this one, you'd say, yeah, boomers have got an argument. They were doing it tough.
Okay.
Um, and then the one that they definitely got that the boomers definitely can't argue about is this property price to wages one where which
This
has
is
just been
incredible.
rising relentlessly. So even at the worst of the times in 1989, you're basically paying 5 times the average salary. So, and just as a ballpark number, I think it was about 160,000 was the average house, and the average salary was whatever that, a bit more than 30 grand.
Yep.
Um, and so whereas now we're talking about it's basically never been worse. It's up to 11 and a half times. Um, I guess, and this was part of this is a lot of the reason I created this was just to show the prior two graphs, which I think are much better indicators. You can actually use them to say, I do think wages, so I do think that rents will limit the house price growth. So if rents don't keep rising, then it's harder. It's much harder for house prices because people will just go, well, yeah, I'd love to buy a new house, but if it's going to cost me twice as much as renting, I'll just rent. Um,
Okay.
and similar with the wages, you've just got to be able to afford it. Whereas this price, obviously you do need to be able to afford to get a deposit, but there are one-off ways people can get deposits, and once you do have the deposit, then you don't have to worry about it anymore. Now you're worried
Once
about
you're
the other
in,
two
you're in.
graphs. Yeah, and there is a lot more people who are in than who aren't. And so, of the people who are in and need to upgrade or do whatever, they really care about that property price to. Sorry, they really care about the mortgage cost. So
But
when
is
they're
that
upgrading,
assumption or is that statement predicated on the assumption that house prices will keep going up? Because if your house price falls back down and you look to transition and sell at a price less than your mortgage, how are you going to get another house?
yeah, well, you don't sound like a good Australian. House prices going down, Shelley. How can house prices go down? That's a
Yeah.
yeah. Now, well, I guess what I'm talking about in here is saying, okay, if you're a first home buyer who's struggling to get into the market, you
Mm.
need to somehow save that money. You might be able to borrow it from friends and not tell people, or borrow it from parents, or get a gift from your parents. Like there's ways you can get that deposit, and then you're in and you're off and running and doing what you can. If you already own a property, and you're trying to stretch to get to your next one, so you bought a property for 600,000, you paid it off, and now you want to buy a $1.5 million property somewhere, because you now need more space and kids and whatever, is you've got this, you're sort of trading your currency that you've already got in for, and so you might be taking, you took out a $600,000 mortgage the first time,
Yeah.
and now you're going to take out $1 million mortgage. And so
In that scenario, it sounded like you said the person had paid off the house already, right?
yeah, that's right.
There
So you're
is
going
this
to trade.
dire one where if your house value drops below your value of your loan on it, that you're going to be in trouble.
Yeah, people tend to look only if you lose your job. I guess so people
Okay,
tend
so you
to.
can't trade though. You wouldn't
No,
be able
that's
to
right. You're
sell
stuck. You're
it.
stuck where you are,
Okay,
and
but
but
if you
the
have a
but
job and you're servicing it, you're okay
the
until we go
history
again.
is people tend to just stick their nose to the grindstone and just stay there and just keep going.
Okay.
Is what typically happens. I mean,
Yeah.
obviously, yeah, not for everyone, but I guess what I'm saying is, upgraders can sort of go, okay, I'm selling my $600,000 one. I'm going to my $1.6 million house. I've got $1 million now in mortgages. In mortgage, I've got a much larger mortgage than I did when I first bought in, but I can afford to pay that still, and the deposit sort of doesn't really matter because I'm just trading in equity from my old house into the new one. And so,
Yeah.
and I guess that's what I'm saying is, um, that person still has to worry about what's the price of how much of my mortgage costing me versus how much would it cost me to rent the same place. That person still has to worry about how much is the mortgage going to cost versus how much they're making in
Yeah.
income,
Okay.
but they don't really worry about the property price to income. And so, and I guess what I'm
Yeah.
saying is there's a lot more people in that situation who either own a house already, and so they don't, and so they're not. This property price to income's not a calculation they need to worry that much about. Um, they should, but yeah, because they're trading in one current, trading
Yeah.
in one
Mhm.
part for another.
Yep. All right. Um, so I guess obviously, you started with this by saying the reason that you built the calculator was because you realized how important rates were in the discussion.
Mm,
Um, and so we've talked a little bit about how we got to this point, but it's probably also worth picking your brains a little bit about where we can go with rates. Obviously coming off the bottom, the sky's the
mm,
are, I think, around wages and immigration. So, wage is really, really topical because that wage increases what drive demand increases, which, drives that good type of inflation that we then
mm.
know interest rates is a good tool for. And the bank has a checkered history in this part. So, do you want to summarize that and maybe talk about where
Yeah,
you think we'll go in that
sure.
respect?
So I'm going to use the property calculator actually for that one as well because those stats are all here. So if we moved this along and said, let's say we think, I'm just going to say that as an example, the mortgage payment to rent. Say we think Sydney's going to average out about 150%. So yeah, it'll go up above that and below it, but we think in the long term, it'll keep coming back to this 50%. Um, then I want to go through to the next screen, which then sort of gives me this. Okay, this is what's going to happen to property under that scenario, but it's also it is based on some of the assumptions that I sort of skipped over very quickly. Those assumptions, though, I do have here. So we can see inflation is one. So we've got this big spike in inflation we've seen at the moment. Um,
Although
you
in
know,
relative terms,
oh, in relative terms, there's nowhere.
it's
Yeah,
not
yeah,
that
that's right.
big.
It's no, not at all. Actually, I should zoom in a bit on.
But so when did banks really start in inflation targeting? Was that in the 80s, 90s?
Independent banks came through in the
Oh,
90s. Yeah.
okay.
And so and this is there's an argument around this whole idea that, well, has the government basically just sort of outsourced some of its thinking on this to sort of, it used to be the government, if you had these problems it was the government's fault because they had the interest rates and they had how much fiscal spending
That's not
was.
my job.
Yeah,
So
whereas now it's, I don't
so
hold a
someone
hose,
tell
mate.
us.
Yeah, I don't hold that interest rate hose. Yeah. um there's um but yeah, so let's though look at wage growth. So, and this is the sort of line that we've seen. This is the issue, and I've broken it out actually to look at real wage growth, just because it sort of gives a better indication. And you can see that sort of real wage growth for most of the sort of early 2000s was sort of growing at around 1%. And sorry, the other thing just confused is this is a 3-year average as well, just to smooth out some of the bumps in it. So
What did it look like beforehand?
yeah, that's right. But you can see that it's just been that's just real wages have just been relentlessly falling for the last 20 years. And we're now back down to well, slightly above zero, basically. Um, Now, this is where the RBA effectively had said, there's a couple of great RBA charts, which they did, to their credit, they did themselves, talking about how they just spent the last decade from basically 2010 to 2020 expecting wage growth to bounce back up to that 1% level. And it just failed every time. So every time they thought it was going to happen, it just wouldn't do it. Then they once sort of the pandemic hit and they were giving this guidance that they're going to keep interest rates low for a long time, is that what they said is they're sort of abandoning some of the forecasting mechanisms, and they're going to wait for wage growth to actually come through before they raised rates. That's
Did they do
something
that?
which no. Um, they did for a
I thought
year.
they were waiting till 2024 too.
We're going to wait till 2024 to raise rates. But anyway, so they've reversed their idea. They've reversed that the guidance they gave about you're holding rates low for into the 2024
Yeah.
or at least
I actually want to
2023.
say something on that, which is like I know I just laughed and I shouldn't have, because it's actually is for everyday Australians that are out there. It's a really serious issue in that they gave guidance. People make decisions to take on big mortgages as a result of that,
Mm,
and feel secure in that. And now 2 years early, and that's a long time.
yeah.
They have made a rate increase, and I just I feel for those people who have been put in this situation where they thought they could trust the Reserve Bank of Australia when they said they weren't raising rates until 2024. Like, that doesn't just affect
Mm.
people who work in finance or people's returns on their portfolios. It affects people's cost lines at the end of the day.
Yeah, absolutely. And the thing is, a lot of these people haven't felt it yet. They're going to feel it over the next sort of year and a half to 2 years, because a lot of people took out 3-year mortgages, and
They've got
the
fixed rate terms.
yeah, and the RBA was specifically holding down that 3-year rate in order and funding banks at a very cheap level in order to get those rates down. So most of those mortgages were written around about 2%,
Yeah.
and if you're refinancing today, it's going to be closer to 4.
Yeah,
Like
wow.
it's just
That's huge.
yeah.
So that's for fixed. That's a 3-year fixed rate, though. If you wanted to roll onto a 3-year fixed rate, but if you rolled off that onto variable, would
Well,
be
no, that's what I'm saying.
closer to 3, wouldn't it?
Yeah,
No?
if you're coming off your 3-year fixed rates, no, you're going to considerably higher. Yeah, so the RBA runs, it's hard to tell what interest rates really are. The RBA runs a couple of different series um, that they have in terms of what are the lending rates. So the latest data that they've got in there that they're putting up at the moment, which they try and make those adjustments for these types of things. So the latest ones they have is from pre the rise, but 3-year fixed rates are 4.3, and so as you said, yep, that it's going to be hard to a lot of people aren't going to go to that. They'll go to the standard variable rate.
Hmm.
So the discounted standard variable rate before the rate rise was 3.45. And so you add another 25 basis points and you go to 3.7.
Yeah. So I said in my intro that people might be looking at a 10% increase, but that's like a 70% increase.
It's big. It
It's
is
huge.
very
Yeah.
big. And so that's going to, yeah. And that's so as you roll off a 2% interest rate, um, you're going much, much higher. I mean, the 10-year Australian government bond, which is like what people lend to the risk-free to the Australian government at, is 3.5 right now. Like it's actually incredible that we can that our these standard variable rates are still only
Mm.
3.5 as well. Like, so you can
That's true.
basically, yeah, for the same price as what the government's going to get for over
But I
10 years.
guess, I mean, the other part of that is that the market is baking in more rate rises, right? And so these
An
people rolling
incredible amount.
off the 3-year fixed or 2.5 years,
Mm.
it's going to hurt far worse than it looks like
Well,
it's going to hurt today.
there's another 3% of interest rates. The markets have priced in 3% more, 3% higher interest rates.
So you'd
So
be looking at going from 2% to 6%.
Yeah, absolutely. Like, so I mean, we add three. So what do we say? We're at 3.7 on the RBA measure at the moment. Add another three to that, so we're at 6.7. Like, it's talking about saying in 3 years' time. Actually, I think it was even less than that. It was I think it was 2 years' time
Hmm.
that interest rates will be at that uh, the RBA rate would be 3% higher than what it is today. And so if interest rates move in the same direction, which they typically would do,
Yep.
you add 3% more to that, and yeah, you're talking about almost 7% interest rates. Um, I I don't think the Australian economy can handle 4% interest rates, let
Yeah.
alone 7%. And so that's one of the reasons why we still think that this is an opportunity this is a trading opportunity for people. But
Okay.
from a somebody who's investing in housing, the danger is, well, I'm wrong, and that they do go to
Mm.
7%. I mean, that's what markets have priced that in today. As at today, they've priced in that interest rates are going to almost 7% in a very short period of time. Yeah.
So we just spoke about wages. Um, I think my understanding is they haven't seen uh, the inflation that they were hoping for, or the wage growth. Sorry, is probably a better way of putting it.
Mm.
Um, but they've made this movement saying that their sources are saying that there is a wage growth out there. But obviously, the other side of that wage growth question is immigration policy. And so we've seen that tighten up a lot during COVID. And my understanding is it's still quite tight post that. Um,
Well,
what do you think's going to happen
it's
here?
it's very it's okay. So in terms of policy wise, um, I mean, nothing particularly changed really, ex the fact that we just you couldn't get here, so and we wouldn't let you in. So it wasn't that it was harder to come from any other other thing, anything other than we were locking everyone out. So regardless of whether you were in the country or not in the country. So there is actually an explicit plan to try and get as many people as possible into the country. Now that hasn't really been working, and so there's
Why hasn't it been working?
well, this is a question nobody really knows. Part of it's China. Part of it is China is certainly there's as limited
Okay.
the number of students. Um, the other one though, the real one is basically just saying, are there are there constraints now that mean that people are going to be less likely to move to Australia in terms of saying on the education side, there's the UK and Canada are competing a bit harder for students. Uh, after the financial crisis, Australia actually had a really good uh, really low unemployment rate relative to a lot of the rest of the world. And so a lot of Australians moved back to get, if they lost a job overseas, they moved back, or people who were overseas. And we had this mining boom going on. They were, they had any skills that were in some way transferable, would go, well, I've lost my job in the UK or the US or whatever it is, and the economy is terrible. Moved, here's a chance to move to Australia. And so that was very much part of it. But the other thing then is with a pandemic, it wasn't, there was a lot of people who were international students in particular who weren't eligible for any of these support mechanisms. And so here you are stuck in another country, for a lot of them a quite high cost country, and you're not getting any support and you can't actually go out and work. And so the question I think sort of would still be lingering in people's heads is 5 years ago you go, yeah, I'll pick up my stuff and I'll move to Australia or move to a different country, and if everything goes badly, well, that's fine, I'll just get a return flight and fly back home. Whereas I think now, I think a lot of people are looking now, going, well, will I have support? Will I have my family there? Maybe if you've got young kids and you, 5 years ago you might have done it, but now you're like, well, if I get locked in and haven't got grandparents nearby to help, and I think there's probably a few of those factors that are slowing it down. Um, People might well forget about those things over time, but I think there probably is at least a short-term effect of all of those slowing down the rate. So, but having said that, both sides of politics would love to get as many people in as possible.
Why?
Uh, Cynically, my cynical view is because it juices the stats. So it basically it says, you know,
Ah,
if I can
growth
have
looks better and property prices go up and right.
If I can have my so basically Australia spent 2010 to 2020 with almost zero real wage growth. So that's real wage growth per capita, but wages were growing. In an aggregate sense, wages were growing at maybe 3%, but
So
growing at
what
zero.
the chart that you just showed us, I think it's just the one up from these
Yep,
ones.
yep. This
Oh,
is on
that
a
one, isn't it?
yeah. This is a per person. This
So
is
that's
real.
per capita, right? So that's what you're talking
Yeah,
about. It's just been falling. Okay. Yep.
yeah. Yeah. But so yeah, so my take is that I think what's happening is that those numbers seem better. You can talk about a GDP growth. Well, we grew our GDP growth at 2%. You're like, well, you grew your population at 2%. It's like, well, yeah, but 2% GDP growth, that's pretty good. That argument sort of goes, and then there's also all the donors. There's a whole bunch of people, a whole bunch of companies that have got very rich over the last 10, 15 years from supplying more buildings, more student accommodation, uh, you know, all the bits that go into the real estate agents and conveyancers and the whole bit, banks, everyone that's sort of all involved in that, all says what a great thing it is that property prices go up, and so uh,
Right. Yeah.
and we build more, and so they're all pushing in the same direction, get more people back in.
Property Ponzi scheme. All
Yeah.
right.
Yeah.
On that great note, do you have any last comments that you feel like you want to add to this conversation, Damien?
Yeah. So, well, just I guess the summary. Your question to me was, who's got it worse, millennials or baby boomers? And I'd say millennials have copped it way worse. So I think there's definitely arguments that for a 2-year period, um, things were worse at a very small peak. But if you're talking about pain over a long period of time and just hard to see the end of it, then you have today's situation.
Mm, okay. Well, that's a pretty conclusive answer. Thank you, Ump.
Yeah.
So, um, as always, thank you for coming to share your knowledge with our listeners. Do you want to let them know how they can hear more from you or get in touch?
Yeah, sure. So every week, podcasting on this channel, we have. If you jump across to the website, you can book a call with a financial planner. We've got try and write, at least once every 2 or 3 weeks. It's I probably should try a bit more often as Shelley's looking at Shelley, but yeah. So there will be something up there that's sort of telling you what we're thinking, and definitely, every month we'll talk about as we do our performance report. We talk in a lot more detail about what's happening and how we're seeing the world.
Thank you. So, before I say goodbye for today, if you have any feedback, podcast topics, please let me know in the YouTube comment section or send me an email at contact@nucleuswealth.com. Did you know Nucleus Wealth offers personalized investment portfolios and limited investment advice? You can find out more at nucleuswealth.com or give us a call on 1300 623 863. And finally, if you know anyone who you think would get something out of today's episode, maybe a friend or a colleague or a family member, we'd ask for you to share it with them and help the show grow. So thanks again for tuning in for myself and the team, and we look forward to catching you on the next one.